You get up 25.40, 25.50, and take out the high we made last month. It's not just because you take out that high, but we've got some momentum trigger levels. Whereas if you looked at a momentum chart, you wouldn't just see a high there, you'd see a ceiling, repeated bumps at a certain level. And when you go through that, it's like it's engaging a structure, is what we call it. And at that point, I think gold will no longer go up modestly versus its April high, but will go up in a more accelerated manner. So to argue now that gold is overbought, I don't quite understand, but it's a widespread notion. And it would be a good time, therefore, to prove they're wrong when the consensus is that, no, it can't keep going up at this rate. I think it can. So I think we're facing an interesting several months ahead.
In the ever-shifting landscape of financial markets, the relationship between gold and stocks continues to captivate investors and analysts alike. MichaelOliver, the renowned financial analyst and founder of Momentum Structural Analysis, offers intriguing insights into this complex interplay. Oliver paints a picture of a potentially vulnerable stock market, suggesting that a mere 5% decline could trigger a more significant downturn. In response to such a scenario, he anticipates central banks would likely increase liquidity and lower interest rates, a move that historically has benefited gold. As of Tuesday, the gold price faces headwinds from a stronger US dollar and rising Treasury yields. However, several factors continue to underpin the precious metal's appeal. Expectations of a Federal Reserve rate cut in September, ongoing geopolitical tensions in the Middle East, and gold's traditional role as a safe haven asset. From a technical perspective, gold faces a critical resistance level in the $2,530 to $2,540 zone, marking the upper boundary of a 5-month ascending channel and the all-time high. A decisive break above this level could propel gold towards the psychologically significant $2,600 mark. MichaelOliver highlights the historical pattern where gold often rises during stock market downturns. For instance, in the 2008 financial crisis, gold initially dropped with stocks, but quickly rebounded to new highs. During the 1987 crash, gold surged by 9%, and in the Great Depression, gold miners saw a bull market despite the stock market collapse. Similarly, gold and Treasury bonds rose while stocks fell during the 2007 to 2009 crisis. Recent data shows a robust correlation between gold and U.S. equities. In August, their positive correlation reached 0.927 on the R coefficient, the highest since November 2005 and in the top 0.5% of all rolling 21 session relationships over the past 55 years. Oliver emphasizes that it's not a hard rule that gold must follow the stock market. Please tune in for our exploration of MichaelOliver's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
During crash events, there's one instance that everybody remembers that was in October of 2008. Stock market had already been going down big time for over a year at that point in time. Gold had been going up for a couple, since 2000 through 2008. And was somewhat overbought then. And so when the stock market finally did have a crash event and a year off of its high in that 2008-9 bear, gold joined in. It joined in for all of about 4 to 6 weeks, where they're going the same way. They weren't going the same way before. And then shortly after that event, stock market continued on down through the first quarter of 2009. Gold was back at its highs by early 2009. So they diverged. But there was that brief instance, and everybody remembers that, at least if you're around then. But if you go back through history and look at even crash events, like I happened to catch the crash in 87 before I set up MSA. I didn't catch it a big way, but I caught it to where it smacked me in the face with realization that, hey, we can measure some of these things. Okay. At that point in time, gold went up 9% that was week or two of that crash. Why? I guess nobody told gold was supposed to go down, when the S&P crashed. But no, it went up anyway. And during the 29 to 32 great bear market, there was no gold futures or freely traded gold then, but Homestake Mining, the biggest gold miner in the world then, had a massive bull market during that huge bear market. Okay, so opposite the stock market. So the attempt to link gold to stocks as a fear element. Yeah, pay attention to it. Yes, if gold were excessively overbought at that point in time, when the stock market decides to really have a puke, then maybe gold will participate to some extent to clean itself up some, or not. So don't think it is a rule carved in gold stone that it must follow the stock market. It certainly doesn't. Okay. Anyway, in the 2007 to 2009 bear trend, stock market down the whole year and a half period, T bonds and gold went up. From 2000 to 2002 bear market, gold went up, T bonds went up. Okay. So here we are. I think we're topping out the stock market. Yes, we've taken out the 2022 price highs by about 10% or so. In some indices, some haven't even reached it. If we roll over here, we think there's triggering factors in the S&P 500 and the NASDAQ 100 that will be engaged in the next quarter. If you merely ooze back down about 5% below where you're trading right now, those indices can't sneeze between now. So if September, for example, unfolds as a wobbly month, and we ooze back down several percent, you'll be in a position via our momentum metrics to trigger a structure, break a structure of support level that suggests you could open the Bombay door. Now, it doesn't have to be a crash, but it's likely to be a very sharp onset of major decline. And I think that the Federal Reserve and the monetary factors around the world will increase dramatically liquidity, artificially low rates. It's all the things they do, and that will benefit gold. So anyway, but we do see the stock market being in a very vulnerable position to where September better not be a wobbly, non-headline, but just wobbly a bit, pull back 3, 4, 5%, because you'll be in a position then to trigger certain momentum factors that say, gone. You'll go down. Anyway, so that's what we see in the stock market. And I think it's likely that those trigger levels will be engaged in the next month, after September.
MichaelOliver suggests that if history is any guide, gold could reach much higher levels, such as $8,000. However, he emphasizes that this is not a specific target, but rather an observation based on past trends. This aligns with Goldman Sachs's outlook, as they also see significant upside potential for gold in the near term. According to a recent note titled "Go for Gold," Goldman Sachs analysts argue that gold has the highest potential for a price hike among commodities, primarily due to its status as a preferred hedge against risk. While other commodities are viewed with a more selective, less constructive outlook due to weak demand from China, gold is expected to benefit from imminent Federal Reserve rate cuts. Goldman analysts believe these rate cuts will attract Western capital back into the gold market, a factor that has been largely missing during the sharp gold rally over the past 2 years. This renewed interest in gold, coupled with the historical patterns noted by Oliver, suggests that the precious metal could be on the verge of a significant price surge. Let's get back to the interview.
We can't put a price level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid-1970s to 1980, went from the mid-$30 level to 850. Okay. Or from 2000 lows of about $265 gold, and you went to 1920 by 2011 over the next 10 years or so. Okay. That's an 8-fold move. Well, we started from a bare low at 1,050. You do the math. Yeah, we're double and a half. Okay. So no comparison in terms of how much multiple gain has gold had so far in this, 9-year-old bull market. So if you use those old metrics and say, well, we can do what we did then, sure you can. The fundamentals are even more dramatic now. Gosh, you can have $8,000 gold. Now, that's not a target. It's just noting past history. And we also note that back in those periods, when you end those bull surges, and by the way, I'd comment on that, maybe have an after comment on this. When you ended those bull surges, that last several quarters of the bull market, you went parabolic. Gold went up hundreds of dollars. Silver went from, like you said, 20 to 50 in a matter of, several months. The same was true in 79 to 80. It's also true in mid 2010 through April 2011 for silver. You went absolutely off the page. Right now, silver's, well below those price highs, $50. Why is silver? Gold's above those comparable highs. Even copper recently traded over $5, taking out its 2011 high and its 2020 high. And yet silver's still, $30, let's say, it's $20 short of its peaks. Do you think it can't get there? And maybe go past it? Well, be reasonable. Maybe silver's just lagged for certain reasons, And once markets like that get shocked into a new reality, they tend to go berserk. And I think that's probably what's going to happen, is that silver's going to vastly outperform gold in the coming months. The areas I gave you just a minute ago, the recent high was 2450 gold, 2540 gold. You get up 2540, 2550, and take out the high we made last month. It's not just because you take out that high, but we've got some momentum trigger levels. Whereas if you looked at a momentum chart, you wouldn't just see a high there, you'd see a ceiling, repeated bumps at a certain level. And when you go through that, it's like it's engaging a structure, is what we call it. And at that point, I think gold will no longer go up modestly versus its April high, but will go up in a more accelerated manner. A lot of people right now are saying, well, gold's overbought. Even gold bulls are saying that. Well, by our metrics, it's not overbought in the least. It's cooled off. You could say that back in April, when we moved up from we had a low this year at 1990 in February, 1992, I think it was, and you ran up to 2450 by April. That's a pretty dramatic surge. So you were overbought then, and you corrected that by cooling off, by going sideways. So we've had a correction that's cooled off all the momentum readings from overbought levels to more normal neutral type levels.
As we look ahead, the potential for gold to reach new highs, supported by favorable conditions such as anticipated Federal Reserve rate cuts and ongoing geopolitical tensions, cannot be overlooked. The interplay between gold, stocks, and other commodities will undoubtedly be an area of focus for investors seeking to navigate these turbulent times. What do you think the future holds for gold? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.